How is everybody doing? You are in the strategy room on this Saturday night, May 31st, 2025. I hope everyone is having a great weekend out there. I am so happy to be back with everybody this weekend. It was a crazy week last week, and I'll, kind of get into all that in a minute and let everybody know what was, kind of happened with me last week and why I wasn't around. But first, let's see. I got a lot coming up tonight, so we're going to be talking about Trump meeting with Jeremy Powell at the White House, talking about interest rates. We're going to talk about what's going on with interest rates. We're going to talk about inflation. We're going to talk about tariffs. We're going to talk about what's going on in the world of banking. We got a lot of great stuff to cover here tonight. A lot of great stories and everything to go over with you guys. I'm going to talk about a little bit about what my plans are for the next couple of weeks, what I'm going to be looking to do there. Or do here rather on the channel with some of the videos. But let's jump into this first. So obviously one of the big news stories of the week was Elon Musk is leaving Doge. And obviously I'm very bummed out about this, not super ecstatic about this, but so they had kind of a going away ceremony, if you will. This was, I believe this article was from Wednesday. And then on Friday, they kind of had a little like 1 hour, kind of leaving, going away ceremony between Trump and Elon, where President Trump was just basically thanking Elon for his service and everything. I am left, though, unfortunately, at least at the moment, I would say I am very disappointed and left with a whole lot of questions. And so if we can, for just a second, let's take a look at our debt clock here for a minute. So we could see here, first and foremost, we are barreling toward 37 trillion in our national debt. We're basically right at 36.9 trillion and counting, still flying up. Interestingly enough, our U.S. federal budget deficit is still sitting at, basically $2 trillion, negative $2 trillion. But very interestingly, the velocity of that money spend is going down, which is a good thing, but certainly nowhere near as fast as we would like it to. But let's concentrate on the Doge clock here for a second. So, Doge clock is saying that basically the Doge has saved us $495 billion, almost $500 billion. At a savings per taxpayer of $4,410. Now, I wish that were true. That doesn't appear to be a true number. It appears that the number is more like 160 billion. But here's the thing. Congress next week is going to come in and they're saying that they're going to try to codify some of these Doge cuts, about $9 billion, which is a kind of a joke. If they saved us 160 billion by all the things that they cut or things that they found, the waste, fraud, abuse, whatnot, they should be codifying a lot more than simply just $9 billion. I mean, that just seems crazy. So that's disappointing. The other thing is, who is going to lead Doge now? I mean, now that Elon Musk is out, who's leading this? Who's taking this baton? I mean, I haven't heard one person say, "Oh, well, this person's taking the baton," or "This person's going to run with this now." So, we're really left here with a lot of confusion. What exactly is happening and who's going to? I mean, some people have said Russ Vought might take the reins here, but I mean, I haven't seen any official announcements. I was just looking, a few minutes ago before we started here, just to see like, hey, has anything been announced? And I haven't seen anything. There were a couple other people who were Elon's like right-hand people, if you will. They all left. They left on Thursday. They left a couple of days ago. So, all the people that were the mainstays that were about 4 or 5 people that were the mainstays with Elon running Doge, they're gone. They're done. They're gone. So I'm just left here going, okay, where does this go down? And you're hearing a lot of happy talk from people about, well, it's the spirit of Doge, the spirit, and it's made us all think about how to be more efficient and how to cost cut and this, that, and the other thing. That's all, to me, it sounds great, but at the end of the day, it doesn't mean anything. Like, it's meaningless. What I would like to see is, like, I would have assumed that they would have put somebody else in charge of Doge, and they would have, passed the mantle, if you will, on to someone else and said, okay, here, listen, Elon's stepping aside. He's got to go back and run his companies. That's fine. But now somebody else is going to pick up the ball and is going to run with this thing and is going to take charge and see what they can do. But at least, like I said, thus far, the results it's very disappointing, because I think that a couple of things here. This was absolutely a once in a lifetime opportunity. We had Doge, no doubt, uncovered tens of billions of dollars of fraud. Why isn't anybody being prosecuted for this? Why haven't any arrests happened? Why haven't any grand juries been convened? What is going on? Why are we not seeing? These are not small amounts of money. It's not $500. It's not $1,000. It's not $1 million. It's not a couple million. These are billions of dollars. And why, like I said, why we're not seeing any kind of prosecutorial action, I for the life of me, I can't figure it out. Why is Congress not, why are they not, codifying a much larger amount of these cuts? Their Doge said they came back and cut $160 billion. Why is Congress only solidifying $9 billion of that? Like, it just doesn't make any sense. And then the other thing is that Doge said that they were going to try to cut, their goal was to cut $1 trillion, from the budget deficit. They were going to find $1 trillion of waste, and that seemed to shut down. Doge didn't even really get into the Defense Department. Like, the minute they started talking about, oh, we're going to go into the Defense Department, we're going to see what's going on there, that kind of got shut down real quick. So there's just a lot of things here that haven't happened that are just very disappointing. I love Doge. I love the concept of Doge. I love what they were doing. We were seeing things for the first time that we had never, ever seen. And it was pretty, I think a lot of the stuff was pretty alarming, because you didn't have, people on both sides of the aisle. It's basically like whether you're a Democrat or a Republican, you're looking at this and you're going, why were we never told about this before? Like, this is pretty blatant what's happening here. Why was this never expressed to us? Why was this never explained to us? Why was this never told? No congressperson, no congressman, no congresswoman ever came forward to tell us about a lot of this stuff, which I think in and of itself is very telling and alarming at the same time. So like I said, so we'll have to see what comes of this in the coming weeks and months. But I just have this horrible feeling that Doge is just going to fall by the wayside, and this is all going to turn into a big, nothing burger at the end of the day. And I think that if that is what happens, I think a few years from now or 5 years from now, we're all going to look back on this and say, man, this might be this might be the largest missed opportunity that we had at basically really, filtering out a lot of the nonsense going on in the government. But we shall see. But all right, let me run on to this for a minute, because this is huge news right here. So everybody's heard of the BRICS nations. That's not new. It's been around for a long time, but this is new. So there is going to be this event on July 6th and 7th in Rio de Janeiro in Brazil called the Rio Reset. Now, this is coming. I found this on Yahoo Finance. There's different articles out there around talking about this, but I thought that this was one, at least it said it like succinctly. So the Birch Gold Group is proud to announce comprehensive coverage of the 17th BRICS Summit, which is scheduled for, like I said, July 6th through 7th in Rio de Janeiro in Brazil. This pivotal event, the Rio Reset, is rumored to be a significant monetary development that will disrupt the dollar-based global financial system. Chaired by Brazil, the summit will convene leaders from the BRICS nations: Brazil, Russia, India, China, and South Africa. alongside representatives of a select group of invited nations, including Indonesia, Iran, Egypt, the United Arab Emirates, and Saudi Arabia. Official discussions will focus on global governance and continued economic cooperation among the nations. But what is this big Rio reset? Well, Birch Gold Group financial market strategist Peter Regan believes the upcoming summit is a Trojan horse. In his in-depth analysis of the Rio reset, Regan makes a powerful case that there's a lot more going on beneath the surface. The Rio reset represents a critical juncture in international finance. Regan says, after 10 plus years of financial and economic engineering, I'm convinced BRICS will make history this summer. BRICS members have become increasingly vocal in their frustrations recently. In Brazilian President Lula da Silva's words, every night I ask myself why all countries have to base their trade on the dollar. Who was it that decided that the dollar was the currency after the disappearance of the gold standard? Reagan believes BRICS will make Lula's wish come true. If the dollar loses its monopoly on international trade, the result would be catastrophic, not just for us, but for our children and our grandchildren. President Trump agreed. In 2024, he said losing the dollar's reserve role would be a hit to our country, just like losing a war, and we can't let that happen. So what are some of the theories here? Now, it's no secret that BRICS has basically said that they want to create another currency, and they want that currency to be backed by gold. And a lot of these countries, obviously, China has been stockpiling gold, as well as some of these other countries have as well in the BRICS community. And again, one of the things that accelerated this was obviously the U.S., the financial sanctions that they put on Russia at the beginning of the Russia-Ukraine conflict, and cutting Russia off from using what's known as the SWIFT system. The SWIFT system is the international system that allows basically banks and everybody to exchange currency and basically wire money, send funds all around the world. Just about every country is on the SWIFT system. And so basically cutting them off of the SWIFT system, and with the other economic sanctions, cutting them off from the dollar, basically, you're trying to strangle them economically. But it had a major backfire in the sense that a lot of countries looked at this and basically said, whoa, if the US can do this to Russia, if something happens, they won't think twice about doing it to us. So, and that basically accelerated a lot of this BRICS conversation, if you will, over the last couple of years, where they've said, wait a minute, we need to really move a lot faster. We need to create our own BRICS currency backed by gold and basically use that to challenge the dominance of the dollar. But now this whole Rio reset, this is something very different. There's a lot of people that are speculating that not only are they going to talk about this new currency that they want to roll out, but they want to talk about a whole alternative global financial system that basically would run parallel to the financial system that's already in place. That could be earth-shattering. And this is one of those few things that keeps me up at night, because I truly believe that people do not understand that if the United States loses its status as the world reserve currency, first of all, I think there are 7 countries that have basically had that status in world history. 7 countries basically had the dominant currency in the world. Britain obviously had it before us with the sterling, and we had the dollar. And once you lose that global reserve status, you never get it back. It never comes back. And your history, you're the future of your country as a world power, major world player, becomes very much in doubt. And the damage that it could wreak upon our economy would be just unbelievable. I mean, with the national debt and with our spending and with the way that we just run our finances, so to speak, as a country. We lose. The only way that we're able to get away with that stuff is because we have the dollar, and the dollar is the world reserve currency. That's it. We lose that status, we lose that power, and our economy is in major, major trouble. So it is a very scary thing, and I'm going to be keeping a very, very close watch on this. Obviously, in a month from now, when we get into July, I'll be really keying in on this. Very, like I said, very, very concerned with what this could mean going forward through the rest of the summer and the rest of the year. But we shall see. We shall see. I will keep an eye on it, and we shall go from there. Now, okay. Before we get into some of our other conversation here tonight, I just wanted to show everybody real quick bond yields. Like, where are bond yields at? Because this is going to play into some of the conversation that we're going to go into here over the next 15, 20 minutes as we get into talking about the Fed and tariffs and everything going on there. Why or why not the Fed, it may or may not be doing anything. So where's the 10-year note at right now? 10-year note is sitting at 4.408%. It basically came back down a little bit. We were sitting in here at, it had jumped up to almost about 4.5. But then we've come back down just a tad to 4.408, but we're definitely up higher than where we would like to be. 5-year treasury right now is sitting at 3.96. Two-year T-bill is at 3.9. And then we go down here, like the 1-year bill sitting at 4.1, the 6-month bill is at 4.3, 3-month bill is at 4.3, and the 1-month bill is at 4.2. So again, we're still in positive territory, but not that far away from going back into an inverted yield curve again. I mean, when you see how high these short-term rates are. And we've had some bumps in the Treasury auctions. As I've been saying for the last few months, we have to keep our eyes on the Treasury auctions. And we had a Treasury auction. I'm trying to think what it was for, but I'm not sure if it was for the 15 or the 30 year, but it did not go well. And it basically caused rates to spike up. Market did not have a good day that day. But then we had a 7-year, we had an auction for the 7-year note just a couple of days ago, I think on Thursday, and that went pretty good. Not too bad. As a matter of fact, I'm going to go into here. This is a big thing here. So, this is a crazy story. South Africa, first black bank collapses after being looted by owners. So lauded as the first black bank in South Africa to be totally owned and managed by Africans, has collapsed after its owners stole all the cash and bribed government and local government officials into depositing money into the operation. So unbelievable. So I'm sure we'll have more on that one here, but sorry, I digress. I didn't mean to go off on that one here, but this is what I was looking at here. So stellar 7-year auction sees highest top through since 2022, but record low dealers. So record low. So again, that 7-year auction was pretty good, but the longer term was not very good. And I'll come back to this one here in a few minutes. Basically, CNBC on the trade deficit numbers, we cut it in half. This really does underscore how the movement of goods and services has really changed due to a variety of tariff-related issues. It's the biggest narrowing of the trade deficit in a single month on record. The trade deficit was basically cut in half, at least for a monthly basis. And I mean, that's just incredible. It's just absolutely incredible. There's nothing, no other way you can say about it. So, but basically right now, as we're going to see in a few minutes here, when we talk about inflation's going the right way. Consumer sentiment's hanging in there. The overall economy's hanging in there. Stock market's doing okay. Everything is going good except for this. These rates here this is hurting us because it's keeping everything elevated. It's keeping all the mortgage rates elevated. It's not helping. It's not helping us right now, whether it's to refinance government debt or it's to help consumers or businesses just to get the financing they need or buy a house or buy a car or go to college or whatever the case may be. It's not helping. And our biggest issue with this right now, and the reason why it's not part of the reason, I don't want to say the whole reason, part of the reason it's not getting better is because of the Fed. The Fed is just not doing anything to help us. And that is what brings me into our conversation here. So Jeremy Powell this week, he goes in, he meets with President Trump, and we get more of the same nonsense out of Powell. So Fed Chair Powell met with Trump at the White House Thursday and told him that rate decisions can't be political. If only he would have told Joe Biden the same thing. But I digress. That doesn't matter. So President Trump met Thursday with Federal Reserve Chair Jeremy Powell amid the president badgering the central bank for lower interest rates. The release indicated that Powell and his Fed colleagues remain committed to setting monetary policy on careful, objective, and non-political analysis, meaning that they are going to sit on their hands and do nothing. So President Donald Trump met Thursday with Federal Reserve Chairman Jeremy Powell amid the president badgering the central bank for lower interest rates. The Fed confirmed in a release that the meeting occurred, stressing that the future path of monetary policy was not discussed. Yeah, okay. At the president's invitation, Jeremy Powell met with the president today at the White House to discuss economic developments, including for growth, employment, and inflation. The Fed statement said Chair Powell did not discuss his expectations for monetary policy, except to stress that the path of policy will depend entirely on incoming economic information and what that means for the outlook. Moreover, the release indicated that Powell and his central bank colleagues remain committed to setting monetary policy on careful, objective, and non-political analysis. The meeting comes at a sensitive time for the U.S. economy, with Trump pushing potentially inflationary tariffs and the Fed trying to balance its mandate to provide full employment and stable prices. I am really getting tired of this crap about the inflationary tariffs. Tariffs, I've said it before and I will continue saying it. Tariffs do not cause inflation. Inflation is caused by one thing and one thing only: government spending. When the government spends a ridiculous amount of money, when the government causes trillion-dollar annual deficits and they put that money directly into the hands of consumers, you cause inflation, massive amounts of inflation. Tariffs are not inflationary. Tariffs may increase the prices of some things, but that's not inflation. That is a price increase. And I'm really sick and tired of this. And here's where I want to show you guys something. So here's the inflation. What's happening with inflation? Oh, let's see here. The inflation rate slipped to 2.1% in April, lower than expected. And this is the Fed's preferred inflation gauge, the PCE. Remember, we have three inflation metrics that we look at. We look at the CPI, we look at the PPI, and then we look at the PCE. And the PCE, that's as the Fed has always said, that is their preferred inflationary gauge. So the Personal Consumption Expenditure Price Index, the Federal Reserve's key inflationary measure, increased just 0.1% for the month, putting the annual inflation rate at 2.1%. Now, what's their target? 2%. So we are literally a fraction of a percent above their own stated target range. And yet Powell is still sitting there saying, well, we're really concerned about the inflation from these tariffs. Really? Then if the tariffs are so inflationary, why has our inflation been dropping for the last 4 straight months? Why are we now seeing a trend of inflation coming down every single month? And yet all we keep hearing about is, all this inflation is going to hit, all this inflation. Core inflation also was at 0.1% for the month, though it was higher on an annual level at 2.5%. Still coming down. We were at over 3% just a few months ago. Now we're down to 2.5%. Consumer spending, though, slowed sharply for the month, posing just a 0.2% increase, while the savings rate surged to 4.9%, the highest in nearly a year. I would posit that both of those are actually good things. We want the spending to slow down a little bit. That's going to help with the inflation. We want the consumer spending to slow a little bit. I believe that is not necessarily a bad thing. Savings rates up a little bit. That's good. Inflation barely budged in April as tariffs President Donald Trump implemented in the early part of the month had yet to show up in consumer prices. The Personal Consumption Expenditures Price Index, the Federal Reserve's key inflationary measure, increased just 0.1% for the month, putting the annual inflation rate at 2.1%, the lowest of 2025. The monthly reading was in line with the Dow Jones consensus forecast, while the annual level was 0.1 percentage point lower. Excluding food and energy, the core reading that tends to get even greater focus from Fed policymakers showed readings of 0.1 and 2.5% against respective estimates of 0.1 and 2.6%. Central bank officials believe core is a better indicator of long-term trends. Okay, fine, fair enough. But the point being is that inflation is not horrible at the moment. It is getting very much under control. It has been coming down for 4 straight months. So we're seeing a softening of the labor market. We're seeing inflation come down. Every other central bank around the world is cutting rates and has been cutting rates. The Bank of England is going to continue to cut rates. The European Union is going to continue. European Central Bank is going to continue to cut rates. Why is the only bank in the world sitting here right now? You have to ask yourself these questions. Why is the Fed the only central bank in the world sitting here, not lowering rates, not doing anything to help us? Every other central bank in every other country is going, hey, we've got some, we might have some tariffs here. This might hurt some of our exports and imports a little bit. And so we should probably lower rates to help out with this, right? Nope, not Jeremy Powell. Jeremy Powell's going to sit there. Jeremy Powell's got a bug up his butt, and he ain't moving. He ain't doing nothing. He's basically to hell with everybody. Let it burn. He's just not doing nothing for us, which is pretty messed up as far as I'm concerned. Here's another article. Powell says interest rate decisions will be non-political in meeting with Trump. The White House meeting came amid intensifying pressure from the president to ease monetary policy as inflation has fallen. So I'm just asking the question. So what happens? Like if inflation comes down to 1% and the labor market, the unemployment rate increases depending on what gauge you're looking at. But let's say the U3, which is the common one that's used. Let's say the U3 goes from like 4.6% where it's currently at. What if that goes up to 5% or 5.6% and inflation's at 1%? Is Jeremy still going to sit there and give us this nonsense and say, oh, I just can't do anything, guys. Sorry. There's just nothing we can do. And it's just, and it's amazing to me what is so frustrating is that we know the Fed can do stuff. The Fed absolutely has a whole toolbox for doing stuff. They can manipulate the short-term rates. They can manipulate long-term rates. They could do they have all kinds of metrics. They could pump money into the market. They could take money out of the market. They could increase velocity. They could decrease velocity of money. They have all these all these different tools in their toolbox at their disposal, and they're just not doing anything. And it's a joke for Jeremy Powell to sit there and say, well, I'm not going to make any political decisions. You are making a political decision. This is exactly what you're doing. Everything by not doing anything, you are being political and you are making a political decision. You're basically telling Trump to go pound sand, and his ego is costing the rest of us. His ego is costing the rest of us. It's costing the entire country. And that is what is infuriating to me. And let's look at some of these other articles here. So now here was interesting. So this is from the Wall Street Journal. The Fed forecasts stagflation. Again, this is one of my other favorite things. So let's look at the last few years. Like I was talking about stagflation last year with Joe Biden's economy, because it was obvious that we were heading into a stagflationary period, but the Fed didn't want to talk about that now. But now all of a sudden stagflation, because Jeremy needs something to hide behind, so he's now going to hide behind the stagflation. This is from the same people that brought you transitory inflation, mind you. Okay, and now we've got stagflation. Officials say a cautious approach will help navigate the risks of higher inflation and weaker growth. So this is key to understand here. This is the financial media running cover for Powell. Okay, this is the financial media going, listen, Powell doesn't want to do anything, and this is why he just can't do anything at the moment, and this is why. They're always carrying the Fed's water, always protecting the chairman of the Fed. The Fed the Fed chairman is beyond reproach, beyond criticism. He can't possibly be making bad decisions or bad choices. That just can't happen. But anyway, all right, I digress off my diatribe here. So, okay, Fed officials worried tariff hikes would increase prices, risking higher inflation, according to the May meeting minutes. Officials agreed heightened economic uncertainty warranted a cautious wait-and-see approach to policy. Rate cut expectations declined after Fed Chair Jeremy Powell said costs of waiting were low and investors expect rates to hold. So the Federal Reserve officials signaled concern at their meeting earlier this month that large tariff hikes would push up prices. It could risk stoking higher inflation. And again, it's all this what if game. What if this happens? What if that happens? What if this? What if this? What if? You know, again, it's not. It's like, okay, well, you know, and that is again, that is very different from what we've heard in the past of like, oh, well, we're going to analyze the numbers. But now it's going to, well, we're going to analyze the numbers under all these ridiculous what if scenarios. So basically, again, making it, I mean, if you're going to run monetary policy this way, you'll never make a decision on anything because you'll just sit, everything will just be what if forever. I could say I could give them 100 what ifs. Well, what if this? What if the bond market does this? What if the bond market does that? What if what if the European Union does this? What if China does that? What like let's just sit here and have analysis by paralysis and just never do anything. Participants agreed that uncertainty about the economic outlook had increased further. Really, what exactly is that uncertainty? Making it appropriate to take a cautious approach until the net economic effects of the array of changes to government policies becomes clearer. That's a whole like what can we get something tangible? Can you give me some tangible examples of what it is? Like we just keep hearing. And again, you notice, and the reason why I show everybody these articles, the reason why I show everybody different articles here is because I want you to notice the language. Pay attention to the key words that you see here in every article. Inflationary tariffs, uncertainty about the economic outlook, cautious approach, array of changes to government policies. Like you see the same very just completely vague language that gets thrown out there. But again, if you repeat it enough times, it then people sit there, oh, well, there must be all this uncertainty out there. And there must be this, array of government changes that's happening here. And it's all this crazy stuff. And it's like, crazy stuff like what? Like, trying to reduce spending, cut taxes, have countries not rake us over the coals with their tariffs. Those kind of changes, that type of crazy uncertainty, I'm not understanding. And then let's go here. So here we go. Here's another one. Fed worried it could face difficult trade-offs if tariffs re-aggravate inflation. Minutes show. So the summary Wednesday of the May 6th, 7th meeting of the Federal Open Markets Committee reflected ongoing misgivings about the direction of fiscal and trade policy. Participants noted that the committee might face difficult trade-offs if inflation proves to be more persistent, while the outlooks for growth and employment weaken. As it has done since the last cut in December, the FOMC kept its benchmark federal funds rate in the target between 4.25 to 4.5, with officials saying policy is well positioned against the current risks. Tariffs could aggravate inflation and create a difficult quandary. The committee reflects ongoing misgivings about the direction of fiscal and trade policy, with officials ultimately deciding the best course to keep rates steady. Participants agreed that uncertainty about the economic outlook has increased further, making it appropriate to take a cautious approach until the net economic effects of the array of changes to government policy becomes clearer. It's just like, I mean, you just keep seeing the same gobbledygook again and again and again and again. Okay, and like I said, the inflation dropping down, going exactly the way that we want it to go. Consumer confidence for May was much stronger than expected on optimism for trade deals. Consumer optimism got a much needed boost in May on hopes for trade peace between the U.S. and China, according to a survey Tuesday. The Conference Board's Consumer Confidence Index leaped to 98.0, a 12.3 point increase from April, and much better than the Dow Jones consensus estimate for 86. Much of the positive sentiment, according to the board officials, came from developments in the U.S.-China trade impasse, most notably President Donald Trump's halting of the most severe tariffs on May 12th. The rebound was already visible before the May 12th U.S.-China trade deal, but gained momentum afterwards. May's rebound followed 5 straight months of declines, Consumers and investors had grown sour on economic prospects amid the intensifying trade war that Trump had launched against U.S. global trading partners, with China a particular target. Okay, I will tell everybody. I'm going to save everyone the suspense. Get ready, because the tariffs on China are going to go back on, and they're going to be way higher. And it's going to happen. President Trump was already out moaning and groaning the last day or so about how China wasn't living up to their end of the bargain. And basically, I think he put a post out there that basically said something to the effect of like, "No more Mr. Nice Guy." So so those tariffs are going right back on. I guarantee you that. So again, so we're going to see this constant, back and forth. And that's a perfect segue right into this. So Trump says he's not chickening out on trade. It's called negotiation. So this week, somebody in their infinite wisdom came up with this ridiculous acronym called TACO, the taco trade. Trump always chickens out. So President Donald Trump pushed back against those using the term taco trade to describe how markets view his tariff moves. Trump suggested his changing tariff plans have helped gain ground in trade talks. Trump has announced and then pared back tariffs targeting the European Union, China, and others. Now, wait, I just want to take a time out here for a second. I don't understand this Trump always chickens out. Trump put tariffs on the EU, and the EU comes back and says, wait a minute, can we take a pause here? Can we negotiate for 60 to 90 days before something happens? Trump says, yeah, that's fine. I'll put a pause for 90 days while we could take time to negotiate. Same thing with China. Same thing with others. Everybody else, he puts the tariffs on, and then they come to the table and say, hey, I want to negotiate. Okay, so we'll take it on. I don't understand how that translates into Trump is chickening out. I don't get that one. That one doesn't make sense to me at all. What Trump is trying to do, and I said this at the beginning of the year when this all first started to come about. It's negotiations. It's negotiation 101. Okay, you're gonna come in and you're gonna basically say, okay, here's what we got. And Trump has already set what's called the anchor. Okay, in any negotiation, you have to set what's called the anchor. It's like setting the price. 10% tariffs. Okay, everybody's getting hit with a minimum 10% tariff. That's the anchor. That's what you can expect to hit. And then basically it's like, okay, let's see if we can negotiate that from there. But that's what Trump is doing. Now, you may ask yourself, well, is it working? And I'm going to show you guys something here. I want to show you two things. So, voila. Look at that. Trump's tariffs deliver a record $23 billion in revenue in May. So May 22nd was the largest day for tariff revenue collections. So in April, our tariff revenue it doubled. It went from like $8.5 billion to $17 billion, and now it's going up to $23 billion. So from April to May, it went up from $17 billion to $23 billion. Did you hear about this anywhere outside of here in the awesome strategy room on the Banker Next Door? So this is why I want everybody to go back and say, man, I'm listening to this Banker Next Door guy, and he's telling me some good stuff here, man. He's got good stuff here. Have you seen this on anywhere? Have you seen this on any? Did you see this on Fox Business? Did you see this on CNBC? No, they don't want to report on this. They don't want to report on how much revenue has been coming in here. We've made $40 billion in revenue in the last 2 months. That's only 2 months. 40 billion. Let's see here. U.S. tariff revenues reach an all-time high in May as President Donald Trump's trade policy started to fill government coffers. According to the May 28 Daily Treasury Statement, revenues from customs and certain excise taxes climbed to a record high of $23.28 billion this month, up from $17 billion in April. May was the first full month that Trump's levies took effect. Most of the tax collections occurred on May 22nd, exceeding $16 billion. Shortly after his April 2nd Liberation Day announcement, the administration imposed 10% tariffs on nearly every country in the world. Fiscal year to date, the federal government's fiscal year runs from October 1st to September 30th. Tariffs revenue totaled $93 billion. Customs and Border Protections, CBD, says it has been implementing and enforcing the president's tariffs using all of our enforcement and revenue collection authorities. CBP enforces tariffs through a combination of legal authority, advanced systems, and operational procedures designed to ensure that duties owed are paid. The CBD said in a report earlier this month, we have fulfilled the demand and remain committed to facilitating legitimate trade while upholding a robust enforcement posture. Last month, the CBD conducted 33 audits, leading to the collection of $117 million in duties and fees owed to the U.S. government. Officials found that imported goods had been improperly declared. Despite the size increase in tariff revenues, it still accounts for a relatively small portion of overall government receipts. In April, Washington generated $850 billion in revenues, meaning levies represented approximately 2% of the total amount. Despite the president's estimates, tariffs are only producing less than $1 billion per day for the U.S. government. That's the start. During a meeting with Salvadorian President, I'm not going to say his name right, Nayib Bukele last month, President Trump stated that the United States was taking in billions and billions of dollars from his trade agenda. We were losing $2 billion a day. Now we're making $3 billion a day, he said. The president has repeatedly threatened new or higher tariffs since the Make America Wealthy Again event on April 2nd. So looking at revenue projections. So in a March 31st interview with Fox News Sunday, the president's senior trade advisor, Peter Navarro, forecast that tariffs could raise approximately $600 billion a year, or about $6 trillion over a decade. The message is that tariffs are tax cuts, tariffs are jobs, tariffs are national security, tariffs are great for America, and they will make America great again, Peter Navarro said. Economists have presented more conservative estimates. The Tax Foundation, for example, anticipate Trump's higher import duties will lead to more than $2.1 trillion in revenue over the next 10 years. But we shall see. Like I said, we are through the first 5 months of the year. This is only the first full month of tariffs. This is the first full month, and we got 23 billion. If we take that, if we could get this up to 25 billion a month, in the next 4 months, we got, we got another $100 billion there. So, and again, we have to wait to see how a lot of these negotiations go with a lot of these countries that are out there right now. We have to give it a chance, but so far, this is going exactly where we want it to go. And I go back here to this. The great Rick Santelli on CNBC, CNBC on the new trade deficit numbers. We cut it in half. This really does underscore how the movement of goods and services has really changed due to a variety of tariff-related issues. It's the biggest narrowing of the trade deficit in a single month on record. So we're getting record tariff revenues, and we're getting a record narrowing of the trade deficit. Exactly what we want to see. Is it spectacular yet? No, it's going to take some time to build, but everything is going in the right direction. It's going exactly where we want it to go, and that is the point. All right, let me get back to, I wanted to go over. Okay, so, but then we had another issue. We had basically a federal court, let's see here if I read this correctly. So what happened was a federal court basically said that Trump could not implement his tariffs, that the tariffs had to be implemented or could only be implemented by Congress. Then we had basically this federal appeals court granted the Trump administration's request to temporarily pause a lower court ruling that struck down most of President Donald Trump's tariffs. The administration had told the U.S. Court of Appeals for the Federal Circuit that it might seek emergency relief from the Supreme Court. Trump officials, including Peter Navarro and Stephen Miller, heaped criticism on the trade court judges following their ruling. So A federal appeals court on Thursday granted the Trump administration's request to temporarily pause a lower court ruling that struck down most of President Donald Trump's tariffs. The Trump administration had earlier told the U.S. Court of Appeals for the Federal Circuit that it would seek emergency relief from the Supreme Court as soon as Friday if the tariff ruling was not quickly put on pause. The judgment issued Wednesday night at the U.S. Court of International Trade is temporarily stayed until further notice while this court considers the motion's papers. This pause gives the Trump administration some breathing room as it prepares to argue that the trade court's ruling should be halted for the duration of the appeals process. Trump officials insist that they have other options for imposing tariffs if they do not prevail in the case. Even if we lose, we will do it another way, Trump trade advisor Peter Navarro told reporters at the White House on Thursday afternoon. Again, this is ridiculous. It's absurd. It's absurd that this court is basically trying to prevent the Trump administration from, continuing these tariffs and keeping them going. But we'll see. We'll see how this plays out. My guess is that sooner or later, this does get to the Supreme Court. The Supreme Court, in my opinion, will shut it. They will rule in favor of this. They will basically say, yes, if Trump wants to put tariffs out there on people, he can put tariffs out there on people. That he does not need, he does not necessarily need Congress's permission to do it. And then here's just another article on this. Trump advisor Hassett is confident tariffs will prevail despite judges' rulings. Kevin Hassett, director of the National Economic Council, said he fully believes the administration's efforts to use tariffs to ensure trade are perfectly legal and will resume soon. The comments follow the ruling from judges on the Court of International Trade who said Trump exceeded his authority on tariffs. So basically Kevin Hassett, he echoes my comments that basically this is just kind of nonsense. It's a bump in the road. It's going to continue to roll out. And, like I said, I think sooner or later it will get to the Supreme Court and the Supreme Court will rule and basically say, yes, Trump can, move forward with this. So that is basically what's going on with tariffs so far. So record revenue coming in the door, a decreasing of the trade deficit and narrowing of the trade deficit, if you will. And basically we got these judges, trying to fight what they're trying to do with the tariffs in court. And we've got, again, stupid people out there coming up with things like the taco trade, basically say, Trump always chickens out because, these guys, panic, because everybody else panics when they get nailed with tariffs and they run back to the table and want to negotiate because that's the that's the strategy. Like what? Okay. Okay. So, all right, so let's get into a couple more things here. So, what's going on? Jamie Dimon had some, the CEO of JP Morgan had some interesting to say this week. So JP Morgan's Jamie Dimon predicts crack in the bond market, citing U.S. fiscal mess. So while China is a potential adversary, potential adversary. Oh man, I gotta love it. The bank executive said America must get our own act together. Well, yes, of course. So JP Morgan chief executive Jamie Dimon delivered a dire warning for the markets, predicting a crisis unless the U.S. takes steps to address its spiraling national debt. You are going to see a crack in the bond market, okay? Dimon said during an interview at the Reagan National Economic Forum in California, it is going to happen. Bond markets have been rattled by the prospect that the already wobbly fiscal situation in the U.S. will worsen should tax legislation backed by President Trump become law. A House-passed measure would increase projected budget deficits by some $2.7 trillion over a decade, adding to a national debt that already stands at more than $36 trillion. This fiscal package spooked bond traders, leading to a sell-off in benchmark 10-year treasuries that sent yields up nearly a quarter point to 4.418 this month. Moody's ratings stripped the U.S. of its AAA credit rating, citing the government's towering pile of debt and amid trepid demand for treasuries at March 21st auction, adding to concerns. Dimon noted that the COVID-19 had left the debt markets in disarray in early 2020 until the government responded with several actions that normalized trading and stimulated the economy, but they massively overdid it in the years that followed. But, and this is fascinating because what is Jamie Dimon? He's saying the government. He's not saying the Fed. He's not saying the Federal Reserve overdid it. He's not saying the Federal Reserve came in and massively overdid this, which is what they did. It's all somehow this all gets back to, oh, well, this is like Trump's fault because he's not doing anything. Like he's not doing anything to try to fix or address the problem. Which is ridiculous. I didn't see Jamie Dimon saying any of this stuff when, Joe Biden and the Fed were just, pumping money like crazy, which spiked the inflation. I didn't hear any concerns coming out of Jamie Dimon's mouth 3-4 years ago. It's just all of a sudden now. But here's the thing. Is he wrong? No, he's not wrong. He's not wrong. It's just that I get irked over what's going on. Now here's the other thing. He's saying that, oh, we could have this crack in the bond market. And again, yes, he is absolutely correct. But who could help us with that? Oh, there's this organization called the Federal Reserve, and the Federal Reserve could dramatically help us with that bond market situation. They could help us by lowering rates. They could help us by doing some things in their toolbox to maybe manipulate the short end of the curve, maybe help us get some of those rates down. They could do things with their balance sheet. They could do a lot of things to help us right now. But and I predict that we will have a cracking of the bond market if the Federal Reserve continues to sit there and do nothing. And what will be extraordinary is if we do get a crack in the bond market, and it's because the Fed sat there and did nothing for 6 months, a year, whatever. What will be amazing is, again, the press will then, the business media will then sit there and say, oh, well, this is all Trump's fault. It's not the Fed's fault for sitting there and doing nothing to help us or help the bond market. No. It's all, everything is Trump's fault. Everything's Trump's doing. And that's just where I get irked with this. So I think that, Jamie is right. We are potentially going to have a cracking of the bond market at some point if the Fed does not step in and help us. And, and at the same time, he basically says, oh, yeah, well, they overdid it a couple of years ago. On the one hand, he's saying, well, hey, they stepped in to help us out to make something better. But then they overdid it. Like, so which is it? Which is it? I would ask Mr. Dimon, which is it? Is it, do you want the government to come in and help? Are you saying you want the Federal Reserve to do something? Or are you saying it's all on Trump and his administration that, the Fed it's totally okay for them to sit there on the sidelines and do absolutely jack, and it all needs to be on the Trump administration? What are you saying here? Was the Fed and the government, were they right in their actions during COVID, or were they wrong? Were they right to come in and massively stimulate, causing all this inflation, causing the massive problems with the national debt, causing the problems in the bond market? Were they wrong to do all that, or were they right? I'd like him to be a little bit more clearer on who exactly he's blaming and what he thinks the issue is. Let's see here. All right. And then he goes on to kind of talk about the military and some other stuff. And then there was this other article here. This is why Jamie Dimon is always so glooming on the economy. JP Morgan Chase CEO Jamie Dimon has regularly warned that the U.S. economy faces perils, but even as he sounds the alarm, his bank is doing better than ever. Oh, you're kidding me. So JP Morgan is doing amazing as the economy, according to him, is about to fall apart. A review of 20 years of Dimon's annual investor letters and his public statements show a distinct evolution. His warnings about the economic calamities became more frequent even as his bank's performance began lapping rivals. Maybe the best explanation for Dimon's dour outlook is that no matter how big and powerful JP Morgan is, financial companies can be fragile. The history of finance is the one of rise and fall of institutions. Well, yeah, I don't argue that point. The more Jamie Dimon worries, the better his bank seems to do. As JP Morgan Chase has grown larger, more profitable, and increasingly more crucial to the U.S. economy in recent years, its star CEO has grown more vocal about what could go wrong, all while things keep going right for his bank in the best of times and in the worst of times. Jamie's public outlook is grim. Whether it's his 2022 forecast for a hurricane hitting the U.S. economy, his concerns over the fraying post-World War II world order, or his caution about America getting hit by a 1-2 punch of recession and inflation, Diamond seems to lace every earnings report, TV appearance, and investor event with another dire warning. His track record of leading the bank is incredible. A board member of 4 banks and investor through his firm Strategic Value Bank Partners, his track record of making economic calamity predictions not as good. Over his 2 decades running JP Morgan, Diamond 69 has helped build a financial institution unlike any other the world has ever seen. All right, let's see here. Yeah, blah, 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 blah. But, so basically Jamie, saying all the time, a lot of doom and gloom, just, oh yeah, this is going to happen. That's going to happen. The other thing's going to happen. And I would say he's probably, less than 50% accurate in some of his predictions. So, but again, I take nothing away from Mr. Diamond. I have tremendous respect for Jamie Dimon. I think Jamie Dimon is a legend in the banking business. He steered JP Morgan through the Great Recession in 07, 08, 09. He got him through COVID. He's made him the biggest, baddest bank in the world. They have a $4.3 trillion balance sheet, which is insane. He has done amazing things for and with JP Morgan. The guy's name is going to be in the history books as when they talk about economic history of the first 25, 30 years of the 21st century. It will be Jamie Dimon will be front and center. He will be the man for the banking business. And I take nothing away from that. The guy has been an incredible banker. Like I said, I just think that some of this stuff he comes out, like I said, I feel like he tries to play. I feel like he's always trying to play every side, every angle. It's like, well, things are great, but we got this over here. We could do better here, but we're doing not so bad over here. Oh, but this could be over. It's always kind of a game of angles with him. Like, all right, I'm going to play this angle. I'm going to play that angle. And sometimes I think it's very smart. I think it's very astute on his part to do so. But sometimes I think it comes off as lacking, as a lot of this did. Where it's basically he's talking about what's going on or what could go wrong with the bond market, but he does it. But he stops short of saying that, hey, the Fed, as he well knows, the Fed could really help us out here, and they're just not doing anything. So yeah. All right, so let's look at a couple other things real quick here, and then I'm going to shift gears in just a few minutes. We're going to go over some of the episodes that I actually did 2 weeks ago. I'm going to tell you guys all my story about what happened to me last week, so hang in there for that. So what was some of the big news stories that happened this week? So Japan's Nippon expected to close acquisition of U.S. Steel at $55 per share, sources said. So obviously Trump had a big rally yesterday over in West Mifflin, Pittsburgh, which was pretty funny for me because I got some family that actually lives over in West Mifflin, which was pretty interesting. But so basically, Japan's Nippon Steel, they are going to make this acquisition of U.S. Steel, but U.S. Steel is basically going to keep the factories open. They're going to keep all the U.S. employees. And a matter of fact, they're going to make a further investment, and they're going to be adding additional employees and actually growing the steel plant, which is great news. I did not want Nippon Steel to basically buy U.S. To me, U.S. Steel is one of those sacred businesses, and I don't want anybody around the world, anyone in the world, owning U.S. Steel. I want U.S. Steel to be just that. I want it to be U.S. Steel, owned, operated in America. It is one of the backbone industries of our country. So again, I'm happy that all the plants are going to stay open, that all the employees are going to stay there. They're actually going to hire more employees. They're going to invest money, expand the plants, all that. That's great. I love it. And I hope that comes to fruition and happens. Still not super happy, though, that the fact that Japan's Nippon, no matter how you cut it, U.S. Steel is now owned by Japan. I'm just not, I'm just not happy with that. Like that just does not sit well with me. And if it was a question of money, U.S. Steel needed more money, needed more capital, or whatever. Like you're telling me like we couldn't have got some banks or some investors, or we could have called Vanguard or BlackRock and basically said, hey guys, get over there and put some money into U.S. Steel and keep them viable. It's just crazy. So, all right, so that was that. And then let's see here. So, all right, mortgage rates. So mortgage rates rose to the highest level since January, but demand from home buyers still grew. And here's why. So the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances increased to 6.98% from 6.92%. Applications to refinance a home fell 7% for the week. Mortgage applications to purchase a home were 2% higher last week than the previous week. So mortgage rates rose for the third straight week last week to the highest level since January, but some home buyers were undeterred. Mortgage applications to purchase a home climbed 2% compared with the previous week and were 18% higher than the same week or 1 year ago, according to the Mortgage Bankers Association's seasonally adjusted index. This, as the average contracted interest rate for 30-year fixed rate mortgages with conforming loan balances at $806,500 or less, increased again to 6.98%, with points decreasing to 0.67% from 0.69, including the original fee for loans with a 20% down payment. Purchase applications were up over the week and continue to run ahead of last year's pace as increased housing inventory in many markets has been supporting some transaction volume despite the economic uncertainty, said Joel Kahn, an MBA economist. According applications to refinance a home loan took the rate increase harder, falling 7% for the week. Refinance demand was, however, still 37% higher than the same week from 1 year ago. Conventional refinances were down 6%, and VA rate refinances dropped 16%. Mortgage rates edged slightly lower to start this holiday shortened week after a monthly report on consumer confidence. So, okay. So, yeah, so again, mortgage rates pushing up on that 7%. Again, not great. If only there was somebody out there that could cut rates and help us out here a little bit. If only. I don't know who could do that, but okay, let's look at some other things with the housing market. So luxury home pending sales hit a decade low as prices remain near record high. So luxury home pending sales hit a decade low. The typical U.S. luxury home price rose 6.5% to $1.35 million. Mismatch persists between buyer and seller expectations on price. Amid a broader reset of the national housing market, pending sales in the luxury segment have fallen to their lowest level in more than a decade. That's according to Redfin Corp's analysis of April residential real estate activity within the luxury market, defined by the real estate company as homes estimated to be in the top 5% of their respective metro areas. Based on prices of homes sold over a rolling 12-month period, Redfin's price tier data is calculated in 3-month periods with the data set covering activity from February to April. The typical U.S. luxury home sold for $1.35 million in April, up 6.5% from a year earlier and nearly surpassing the record set a month prior, according to Redfin. So again, luxury home sales hit a decade low as the price just continues to skyrocket up to an average of $1.35 million for luxury houses. Pretty crazy. A growing force is emerging in home buying. Here's how the market has shifted. Now, this is really interesting. Home buyers in 2025 have never been older. They've never been older. They've also never been more likely to be single or female. Those changes have broad repercussions for the housing market, experts say. So according to the National Association of Realtors 2024 profile of home buyers and sellers, 73% of home buyers in 1973 were married couples. 11% were single women and 10% were single men. By 2024, the percentage of married couples had shrunk to 62% and the number of single men had slipped to 8%, while the percentage of single women had jumped to 20%. We've seen this demographic shift due to women attaining higher education levels, leading to senior positions and greater financial independence, said Veronica Crego Flores, managing broker at Tampa, Florida-based Genstone Realty. As a result, many women are delaying marriage and choosing to invest in home ownership. The market was and will continue to change to match that shift. That includes offering smaller homes in safe neighborhoods surrounded by amenities. Paul Epperly, president of the Greater Fort Worth Association of Realtors in Texas, also stressed that while many people may think the single women demographic that is buying homes is younger, those buyers actually represent people of all ages. He pointed to another reason for the demographic shift. It wasn't that long ago that women couldn't get a mortgage to buy a home, Epperly says. In 1974, thanks to the Equal Credit Opportunity Act, women could buy a home independently. Since then, more women have entered the workforce and become the primary source of income for their families, allowing women to fulfill the American dream of home ownership. Robert Washington, broker at Savvy Buyers Realty in Florida, said many single women he has worked with on home purchases cite the feeling of independence and security it gives them. I also think the American dream has changed for most women. Washington said a few decades ago, women were more likely to aspire toward getting married and having children rather than pursuing a career. Certainly for better, that is no longer the case. Certainly for better. Certainly for better. I would argue that point. I would say no. I would say no, this is not for the better. This is absolutely not for the better. This is why our birth rate has plunged. This is not a good trend. This is not a good thing. We need people getting married and having families and starting families and buying houses together. We do not need, we do not need a quarter or, 30% of the market to be, independent women buying houses on their own. That's not going to work for us long term. That is a catastrophe. That is not a good thing. There's nothing positive about it. That is a catastrophe. And I love how the article, it's so much like, again, the women empowerment. Oh, the women empowerment. And that's great. That's great. Okay. But why were single men, why have they slipped from, 10% down to 8%? And why does that number continue to plunge? Why is there no focus on this? Like this, and this is the big, to me, this is the big issue. What is happening with men? Why are men not going to college? Why are men not buying? Why are less men buying houses? Less men going to college? Something must be happening there. I'm not gonna get in onto a whole diatribe. I'm just saying this because I want people to think about this issue. This is not good. This is not good. This is not good. We are not heading in the right direction. Going from 73 in the last 50 years, going from 73% of home buyers being married couples, dropping to 62%, and having a large percentage of single women going from 11% up to 20% and climbing. We're going the wrong way, folks. We're going the wrong way. That is not the way we want to be going. That is not healthy for society. And it's demographics, as it has been said before, demographics are destiny. And that is taking us in the wrong direction. And then here's another, and I think this is my last article here. I'll cut this conversation off on here. So first-time home buyers are struggling. That's bad news for builders. Even with construction companies offering cheap mortgages. What's a cheap mortgage? Youngish people are finding it difficult to enter the market. Yes, of course. Yeah. So basically this article says that a lot of the home builders, D.R. Horton, Lennar, Pulte Group, they're having a hard time selling houses because they can't basically build an affordable house right now. First-time home buyers share of home purchases. You can see here, really, really dropping down here. We saw a little bit of a spring back in 23, but in 24, we dropped down to, 24%. So we're definitely not heading the right way. And it's because, the cost of housing in the last 5-6 years has just absolutely gone through the roof. And it's made it completely unaffordable for, young people to buy a house. I mean, it's just really, really difficult sledding right now. So definitely something that we need to keep an eye on here. So, okay. All right. Let me Let me switch gears for a couple minutes because this is the time in the show where I like to get into a couple things. I like to talk about the episodes. Usually I talk about the episodes that came out last week, but this is going to be the episodes I put out basically 2 weeks ago because of issues. So last week, everybody out there might be wondering, they might be going, what? Yeah, hey, Joe, what happened? So last week I ended up coming down with a very severe staph infection in my hand. Got a cut in my hand, which led to a severe staph infection. And I spent basically the whole week in and out of the hospital, and it sucked and it was horrible. And I basically had to have a whole lot of antibiotics. Thankfully, everything was fine. It's all started to go back to normal. I feel great. No issues. So the infection's gone away and everything is looking good. So it was very touch and go there for a couple of days. It was looking like I might have needed possible hand surgery, some other things. And it was just, so I was very, very thankful. Huge shout out to the doctors and the staff. I don't know if I want to say the hospital, but I really appreciative of all of them and just did a wonderful job. And thank you so much for taking good care of me. Then I had further bad news. So on Tuesday night, anybody who's watched the podcast here over the last year and a half, 18 months or so knows, I have a bunch of cats. I basically have 4 cats here. I don't know if you want to call this I'll call this my filming area, as it were. One of my cats in particular, Cooper, she's kind of a bigger calico cat. She was kind of like my buddy who always hung out here. She had a little box over here, over to the side, and you would hear her from time to time. She was kind of like my ornery old cat, and you would hear her crying very loudly from time to time in the background on some of the videos that I shot. And unfortunately, after 18 years, had to put her to sleep on Tuesday night. So it was very, very sad. Definitely good. She, like I said, she was kind of like my recording buddy, if you will. She was always around me, kind of hanging out with me while I would be doing my recordings or live streams and stuff like that. So the other cats kind of don't like to be involved. They kind of do their own thing, as cats usually do. But so I definitely a bummer that happened. So like I said, it was kind of a crazy weekend, as you can imagine. That's why there was no live stream last Saturday, because I was sitting in the hospital last Saturday night. So, and I didn't get a chance to. I was working on a bunch of episodes for this week, but didn't get a chance to finish them. Didn't get a chance to get them out there. So it kind of backed up a little bit. So what do I have going on for the next couple of weeks? So I've got some things coming up. So first of all, very excited. I'm going to be down. I have mentioned before in the past, I'm actually a teacher. I'm a faculty member at the Stonier Graduate School of Banking, which a little biased. I think is the best banking school in the country. And so it's time for us to do we basically, the school does a week in person every year, usually first week of June. We go down. The school takes place over about an 8-day period of time, and it goes from one week to the other. It cuts across the weekend. Basically starts on Thursday and it's Thursday to Thursday. And so basically in between, so basically for the working professionals, they go down to the school, they're there for a week, and then they go back and they have a bunch of assignments, in between. So basically it's a 3-year program. You go first year, then in between year 1 and year 2, you have a couple of papers. You have like a bank analysis paper, an economics paper you have to do. You complete those, come back for year 2. And then between year 2 and year 3, you have to do what's called a capstone project. And you could basically think of that as like a thesis. You have to do, in order to graduate, you have to successfully complete the capstone. And then in year 3, you actually come back and you have to present the capstone project. So a couple of things that I do at the school is I'm a capstone advisor. I advise a number of students every year on their capstone. And then I help with the facilitation of all the capstone projects when we get to the school for year 3, which is usually probably about 175 to 200, maybe some in years past, we've had as high as like 225 students. Third year graduating students going through, presenting their papers and going through the whole school itself. You have probably about 700 plus students between year, 1, 2, and 3. Down there to school. So yeah, about probably 700, a little more than 700 students every year down there. So so it's a good size. It's a big class with a lot of students coming in and out. So, but I will be doing that this week. So starting on Thursday, I'll be down there for Stony Air. Very excited to do that. So I'm trying to figure out live stream next weekend. There may be a live stream, might not be a live stream. I'm kind of 50-50 on it right now. I've got to see if I can. I'm trying to figure a couple things out. But if there is no live stream next week, there'll still be episodes. Like I'll still have episodes out. I'll have episodes out every day this week. I'll have episodes out every day the following week. So there will definitely be episodes. And I might even do, because I'm a little backed up from last week, I might even do back to back this week. Like I might actually, instead of just 5 episodes, I might have 7 or 8 come out because I'm sitting on about 8 bank reports that I have to cover. And I usually like to do those like 1 per episode. So I might this might become bank report week, where I put out 7 or 8 episodes just covering all these bank reports. And then the following week might I've got like 5 books that I'm working on book reviews for. So the next week might become book review week. But we'll see. We'll see. I'm like I said, I'm going to figure all that out tomorrow, and then I'll start putting some stuff up and keep your eye out for posts, because I will put up posts on YouTube basically saying like, hey, here's what episodes are coming out, or here's what I'm working on, here's what's going on, just to try to keep people a little informed as to what's happening. So okay. That being said, let me just talk about the last 5 episodes that I put out from 2 weeks ago. So, okay. So I had episode 387, which was an interview with Dr. William Minnis, who is a former bank CEO. He goes by Bill Minnis. So Bill's a good friend of mine. He's a former CEO of a bank that was called Citizens National Bank of Paris, which was located in Paris, Illinois. I don't think that far from Chicago. But basically, we discussed being a bank CEO during a difficult time, what he did and did not like about the jobs, things he would do differently, and what advice he would have for someone becoming a bank CEO today. And then, outside of banking, Dr. Minnis has been involved in various organizations. He spends time consulting. He actually tends cattle at his house in Scotland, which is pretty interesting. He is a professor emeritus at Eastern Illinois University, and Dr. Minnis has an MBA from Indiana State University and a PhD from St. Louis University. But Dr. Minnis is a great guy, and I was very happy that he took the time out to do that interview with me. So check that out if you have a second. Then I did episode 388, which was called, Will There Ever Be Another Warren Buffett? And I thought this was an interesting question, because this was based on an article from the Wall Street Journal, called Why There Will Never Be Another Warren Buffett. And the author provides 3 reasons why there will never be another Warren Buffett. He talks about the person, the period, and the package. So Warren was a very unique individual who was obsessed with studying companies. He was trained by a legend, Benjamin Graham, himself a financial legend. Buffett began investing at a period before trillions of dollars had poured into the stock market, and Buffett used Berkshire Hathaway as his investment vehicle, which is a publicly traded holding company, not like a hedge fund or private equity fund, but a holding company. So a very different vehicle that he used to do his investing. Also, the guy was around for 60 years. 60 years. I mean, who lasts in anything for 60 years? I mean, that's like Tom Brady being an NFL quarterback for 23 years. I mean, it's just unheard of. I mean, nobody lasts that long. Then I did episode 389, which was called Wow, Housing is Unaffordable. So in this episode, examined a report from the National Association of Realtors and Realtor.com titled Affordability and Home Building State-by-State Report Cards. This report breaks down state-by-state affordability and supply. Some of the key findings focus on income-based affordability gaps, deficit of affordable homes, impact on first-time home buyers, state-level disparities, and impact of mortgage rates. There's a link to the report in there. It's a very cool interactive report. If you get a chance, if you're curious about your state and how they stack up in terms of affordability and supply and what's going on there, each state has a report card. Go check it out, because I think it's very interesting. Some states are probably exactly what you would expect, but there were a lot of states that weren't what I expected. So again, if you have some interest, go check that out. And then I did episode 390, which was called "What Back Office Upgrades Can Drive Efficiency." So in this episode, examined an article from Independent Banker magazine titled "Drive Efficiency with These 9 Back Office Upgrades." So the 9 recommendations for increasing efficiency include: automate loan exceptions, use RPA, which is robotic process automation, to reduce repetitive tasks, establish common sense practices, reduce the use of spreadsheets, get maximum value out of existing solutions, have AI help with the compliance, enable e-signatures, prepare for AI drive opportunities, and tap into employee insights. So it's a very interesting article. The only one I didn't agree with was the spreadsheets. I love my spreadsheets, man. Leave my spreadsheets alone. All right, and then the last one I did was episode 391, which was called "How Do Community Banks Maintain Culture?" And this episode examined an article from Independent Banker magazine titled "Workplace Culture: A Make or Break for Community Bank Employees." So the article recommends 6 ways that a community bank can maintain a strong culture. They include hiring with culture in mind, set cultural expectations, a chance to speak up, reward and recognize, demonstrate empathy, and team efforts start at the top. So again, I don't think that there is anything more important in not only a bank, but any company out there. Culture. It all comes down to culture. If you have a horrible culture, your company is not going to do well, and it's not going to run well. I think that any great company has a great culture, and you will see, if you study enough businesses over time, you will see that time and time again. So it doesn't matter whether, I mean, it always helps if it's a bank and you have a great culture. That's wonderful. But if you don't, like I said, things aren't going to go well for you if you have a bad culture. So those were the last 5 episodes I put out. Obviously, like I said, definitely more episodes coming this week, and I'll have a lot more coming. So just keep an eye out for this week as they roll out. Okay. Let's talk about economic indicators for a minute. I always like to put out what are the economic indicators coming out this week. So on Monday, June 2nd, we have the manufacturing PMI, we have construction spending, we have the ISM manufacturing PMI. We have Fed Chair Jeremy Powell is going to speak at 1 o'clock on Monday. On Tuesday, June 3rd, we get factory orders. We get the JOLTS job openings. We get API weekly crude oil stock. On Wednesday, June 4th, we get the ADP non-farm employment change. We get the FOMC member Bostic is speaking at 8:30 a.m. Services PMI, ISM non-manufacturing PMI. We get the beige book at 2 p.m. On Thursday, June 5th, we get continuing jobless claims, initial jobless claims, trade balance, and non-farm productivity. And then finally, on Friday, June 6th, we get the average hourly earnings, the non-farm payrolls, unemployment rate, participation rate, U.S. Baker Hughes total rig count, and consumer credit. So a lot of economic data coming out this week. Obviously, I think two of the big things are going to be Jeremy Powell speaking on Monday at 1 p.m. A lot of people look at that. I'm not expecting anything out of that. What did we just talk about for the first hour of the show? I mean, Jeremy Powell's not going to do anything. He's going to come out with his same lame excuses, and he's basically going to say, oh, he's going to hide behind tariffs. He's going to say, I just can't do anything, guys. Sorry, guys. I just can't do anything. That mean Trump. And I would highly expect that 5 seconds after he's done talking, Trump will be putting out tweets going, too late, pal. He's a loser. He is not interested. I'm sure that will happen. I think, Bostic's going to talk. I think he's going to say this. He's going to say the same dribble. He's going to come out and say, oh, we have to wait and see. We have to be cautious. We have to look at the numbers before we could possibly do anything, blah, blah, blah. The beige book, again, I think it was just going to show exactly what we just talked about earlier. It's going to say, oh, the Fed members are undecided. They think we need to wait for all this economic data. We think we need to see all this other stuff to come out, and, yada, 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 yada. So, okay. All right. Well, last thing I have before we get back to the articles and stuff here, guys, is I like to run through some banking news for the week. So GDP decreased 0.2% in the first quarter. So the gross domestic product decreased at an annual rate of 0.2% in the first quarter, according to the Commerce Department's second estimate. In the fourth quarter of 2024, real GDP increased 2.4%. Pending home sales decreased in April. Mortgage rates were up, as we talked about a few minutes ago. So the Treasury is sanctioning a Philippines-based company for cyber scams. So the Treasury Department sanctioned Funnel Technology Inc., a Philippines-based company that provides computer infrastructure for hundreds of thousands of websites involved in virtual currency investment scams, commonly known as pig butchering. The Treasury Department noted that Americans lost billions of dollars annually to these cyber scams, and Funnel has directly facilitated several of these schemes, resulting in over $200 million in U.S. victim-reported losses. So, yeah, so that's good. So we shall see what happens to that. FOMC members cite unusual level of uncertainty in minutes. This is what I was just talking about in the Beige Book. But members of the Federal Reserve's rate-setting panel said the uncertainty of their economic outlook is unusually elevated, according to the minutes of the Federal Open Markets Committee from May 6th and 7th meeting. They basically citing uncertainty around the evolution of trade policy, as well as about the scale, scope, timing, and persistence of economic effects. FOMC members said downside risks to employment and economic activity and upside risks to inflation had risen ahead of the meeting. I think you're going to see the same gobbledygook on out of the Beige Book on Thursday. So again, I don't think there's going to be any surprises there. Weekly mortgage applications dip. We talked about that. Trump vows to end GSE conservatorship. This is, I've been waiting for this now for 16 years. President Donald Trump said he is working to take Fannie Mae and Freddie Mac out of conservatorship while maintaining an implicit government guarantee on their obligations and securities. On Truth Social, Trump said the government-sponsored enterprises provide a vital service to the nation. Yes, absolutely. I've done a couple episodes on this. If you're interested, go look at it. I give all the background, all the details on that. So feel free to go, check that one out. But we need Fannie Mae and Freddie Mac to get back to being public companies again. And I've said this before, you will hear what I feel are ridiculous excuses as to why to not, to unnationalize Fannie Mae and Freddie Mac and send them back to the private industry. You'll hear things like, oh, well, they're going to want a backstop. They already have a backstop, guys. They already have a backstop. But here's the key at the end of the day. And this is what it all boils down to. Fannie Mae and Freddie Mac make a lot of money. They make a lot of money. And right now, because they're nationalized, you know who has control over that money? Congress has control over that money. And wait for it, that's money that they don't have to, that's not tax revenue. So that money, that's like free money coming in the door. Okay. That's their own, and they've been using it as their own private slush fund. Okay. They take all those funds and then they appropriate them however they feel they want to. That's ridiculous. That's got to stop. Okay. And that's what has prevented them from getting out of being nationalized, out of conservatorship for the last 16 years, because Congress loves having that slush fund, if you will. They love having that money, all that money at their disposal that they don't wait for it. They don't have to ask taxpayers for that money. That money is just coming in. They don't want to give up that gravy train. So that's the big impediment here, is what has stopped this, but it needs to happen. Congress doesn't need control over those funds the way that it is now. Okay, that's my diatribe on that. So we'll get off of that. So, okay. From the ICBA, latest credit union acquisition shows a need for policy action. After a new acquisition of a tax-paying community bank in Arizona by a tax-exempt credit union, ICBA said the need for policymaker action is urgent. In a national press release, ICBA President and CEO Rebecca Romero-Rainey said the credit union industry's tax and regulatory exemptions have been rightfully scrutinized in recent months. Policymakers must address this taxpayer-subsidized consolidation brought by growth-obsessed credit unions taking advantage of loopholes and act to preserve market choice for consumers and small businesses. Yes, I totally agree with her. A lot of these credit unions have just gotten way too big, and it's time for that tax treatment to end. Absolutely. Grassroots campaign on Durbin-Marshall Amendment continues. So while Congress is out of session this week for congressional recess, ICBA continues calling on community bankers to urge their senators to oppose an effort to attach credit card routing requirements as an amendment to pending stablecoin legislation. So Senator Roger Marshall last week filed a proposed amendment to the Genius Act to create new credit card routing mandates. The proposal, which Marshall has sought to advance in previous Congresses with Senator Richard Durbin, would face a costly overhaul of the payments landscape and credit card rewards programs and reduce consumer access to credit for the benefit of large merchants, including Amazon and Walmart. So, yes, I think, is the proposed legislation totally wrong? I don't think so, but it's bad enough that it's like, yeah, that probably needs to not be a part of the Genius Act. I'll just put it that way. Okay, community bankers meet with Treasury's Bessent. So several ICBA members last Friday participated in a roundtable discussion with Treasury Secretary Scott Bessent. The community bankers and Bessent discussed providing access of credit to small businesses and consumers in their communities. Bessent was also interested in hearing how policy changes could remove barriers to capital. After the meeting, Bessent said on X, community banks have been the lifeblood of American entrepreneurship and economic growth since our nation's founding, and they remain vitally critical to economic growth. He added that under the administration of President Donald Trump, it's Main Street's turn to shine. Love it. It's great. ICBA remains engaged as Senate continues consideration of the stablecoin bill. So ICBA continues engaging with the Senate as it works to move its version of legislation to establish a regulatory framework for payment stablecoins. The guiding and establishing national innovation for U.S. stablecoins, the Genius Act, which the Senate advanced a procedural vote last week, would establish a federal regulatory framework for the largely unregulated stablecoin market. The bill outlines requirements for payment stablecoin issuance by banks and non-banks, including reserve and AML BSA requirements. So ICBA is looking for a couple of key things there, and we'll see what happens. So ICBA continues urging grassroots outreach on the Durbin-Marshall Amendment. All right, we already talked about that. So voila, some of the banking news I had for you guys for this week. So, all right, let's get back to some articles here. So I still got a bunch of stuff for you guys here. We're not done yet. Hang in there. I still got a lot of stuff to go over. All right. All right, let's talk about student loans here for a few minutes. So this was an article from the Wall Street Journal, how student loan crisis will show up in the economy. So millions of Americans suddenly owe billions of dollars in student loans after years of forbearance. So millions of student loan borrowers are newly delinquent, sinking credit scores with economists forecasting a GDP trim. The Trump administration began collections for defaulted loans, a shock for many, especially those new to repayment. So millions of Americans had their student loan payments put on pause during the pandemic. Now they are back on the hook again. For borrowers, this means that every month, money that they presumably use to spend elsewhere is going to pay off debt instead. Many who are paying are now considering delinquent or defaulted, a status that sinks credit scores. Around 5.6 million borrowers were marked newly delinquent on their student loans in the first 3 months of this year. That will strain personal finances. At the same time, it creates fresh challenges for the broader economy. Borrowers have been required to repay their student loans for some months now, but just this month, the Trump administration began putting millions of defaulted student loan borrowers into collections and threatened to confiscate their wages, tax refunds, and federal benefits. The collections process was standard before the pandemic, but it is still likely to be a shock to those who haven't experienced it before or who forgot what it was like. Economists at Morgan Stanley estimated this month that payments this year will rise by a collective $1 billion to $3 billion a month. That could trim 2025 gross domestic product by about 0.1 percentage points, they said. So, yes, shockingly, if you take out a debt, you have to pay it back. Shockingly, right? Like most people don't understand the concept here. You borrow money, you have monthly payments that you use to pay that debt back over X period of time. And yes, you are expected to make those monthly payments. If you don't make those monthly payments, you will be held in default and you will have a judgment placed against you and it will hurt your credit score. Yes, all those things will happen. Like this is not shocking. Kindergartners are capable of understanding this, much less college students. So, it's an interesting thing here. We're going to see here in a minute when I show you guys some of these other articles when I get into this. Again, I have empathy and I don't, because I look at it like, hey, if you took out that debt, and look, nobody twisted your arm. Nobody put a gun to your head and made you go to college. Okay. You did that. That was your choice. You decided to go. You decided to sign on the dotted line for those student loans. So from that perspective, no, you took out that debt. It's your obligation. You have to pay it back. Sorry. At the same time, do I think that there is a major problem with college institutions? Yes. Yes, the quality of college has gone completely into the toilet. The degrees that they're selling people are garbage. There is a vast amount of just totally garbage degrees out there that people don't realize that when they get out, that there are careers that pay them next to nothing, or they can't get a job. And that I think is the really, really messed up part. And if you are one of those individuals, I do have some empathy for you, because that's not right. And again, I'm not going to get into the degrees on it. We all know what the degrees are. We've all heard it. We've all seen all the jokes online. We've seen all the memes. We've seen all that nonsense. I'm not going to get into all that, but because everybody knows what it is I'm talking about. So something has to be done with the colleges. Now, I would also say that we need to make a bigger push toward trade schools. We need to get people going into trade schools again. We need to build manufacturing again. Does it need to be 1970 manufacturing? No. But can we add a lot more manufacturing? Yes. I think that, look, when you look at the college statistics, I'm going to throw some statistics at you here, guys. 60% of kids that start college don't finish. 60% don't finish. You know what that tells me? That tells me there's a whole lot of kids in college that shouldn't be there, that should have never been there in the first place. Does that mean that they're idiots or that they can't do anything? No, absolutely not. It just means that college ain't their thing, and that they would be better off learning a trade or learning a skill or learning to do something else. That's number one. Then you get so you get kids that go in, they do a year or two of college, they accumulate student debts, and then they drop out. They don't have a degree. They didn't even get a degree. And now they still have student loan debt that they got to pay back. And now it's like, and what are they doing? It's so that's a big problem. Then you get the kids that most kids don't graduate college in 4 years. The average college student, it takes them 5.5 years to graduate from college. That's the average college student. It's not 4 years, it's 5.5 to get through. And why does that happen? Oh, well, some kids go to colleges. They don't like the college. They decide to transfer. Well, when they transfer, a bunch of their credits don't go with them. So they have to retake a bunch of classes, or maybe they started with one major, didn't like the major. Just halfway through, they decided to switch the major. And then they found out that they had to do other things to meet that major requirement. There could be a whole number of reasons as to why that happened. But the point being is that it takes a lot longer. So it takes 5.5 years. So that extra year and a half, you're adding a ton more student loan debt on top of you with that extra year and a half by not being able to complete the degree in 4 years. So there's a big issue there. 60% of the students in college now are women. 60%. Only like 40, only like 39% of people in college are men. That's a problem. Again, I asked that question. It goes back to what we were talking about 20 minutes ago with the housing market. What's going on with guys? I'm not saying the women empowerment thing is a bad thing, but I think it's a fair question at this point to say, has it gone too far? Has it gone too far? Has it gone to the point where we're everything is, girls 24/7 and the guys are just left by the wayside? Like what, that seems, maybe my perception's incorrect, but that seems to me what is going on. That's a problem. that's an issue that has to be addressed. We have to do something about that. But okay, but I digress. Like, so I think that there are issues there that need to be fixed. But let's get back to the student loan debt here for a second, right? So obviously we can see here from this chart, student loan debt, which was basically, it was put on hiatus for all of the Biden years as Biden tried to, cancel a bunch of the student loan debt, which he was told by the Supreme Court that he couldn't do, but he did it anyway. Thus setting a precedent, this little precedent for, presidents ignoring the Supreme Court. Just saying, that might be relevant in the next couple months. We'll see. But obviously we're seeing the student delinquency spike back up because the payments have kicked back in. A lot of kids can't afford to make these payments, unfortunately. But then let's go to some of these other articles here. So student loan borrowers in default could see up to 15% of Social Security benefits garnished. Social Security beneficiaries are at risk of receiving a smaller benefit if they've fallen behind on their student loans. The Trump administration has resumed its collection activity on federal education debt and appears to be providing less notice to borrowers than the Education Department historically has. Social Security beneficiaries are at risk of receiving smaller benefits if they've fallen behind on their student loans. The Trump administration recently announced it would move to offset defaulted student loan borrowers' federal benefits and warned that payments could be garnished as soon as June. Well, all right, so I've got some issues with it, but let's look at this. So there are some 2.9 billion people aged 62 and older with federal student loans as of the first quarter of 2025, according to Education Department data. That is a 71% increase from 2017, when there were 1.7 million such borrowers. According to the data, more than 450,000 borrowers in that age group are in default on their federal student loans and likely to be receiving Social Security benefits. All right, so I want to add some caveats to this one. First of all, there are not 2 million people aged 62 and older with federal student loans. This is grandmom and grandpop have signed for granddaughter or grandson's student loans at X college. They had to co-sign for them. This is not, yes, again, I could go into banker talk all day long, and I could tell you how, you co-sign on a loan, you're liable for that loan. Yes, 100% true. It is what it is. But I just want to make the point, like, this article almost seems to say that, like, oh, all these 62-year-olds just got out of college and are repaying this debt. No, they are co-signers for their grandkids. And I think this is a little messed up. And I don't think, again, and this gets into what I'm about to talk about here, and that is, I think Republicans are handling this whole thing very, very poorly. You're not going to win people over, especially your older demographic and younger demographic, by doing this. Garnishing the Social Security of a bunch of retirees because they co-signed, they were kind enough to co-sign for their grandkids' student loan debts while they were in college. That's not cool. That's not cool. That's not good. And again, and it's not that these people are not paying. It's not that they're not making the payments. The grandkids who took out these loans, they're the ones who are not making the payments, not the Social Security not the retirees. And a matter of fact, I would say probably in most cases, the retirees are not aware that the grandkids are not paying these debts. They're not aware that these things are hitting their credit report. I guarantee you that is probably the case in the majority of instances here. So this is an issue here. And then we go to the next one here. Court order challenges Trump's plan to move federal student loans to the Small Business Administration. I don't know who came up with this. This was the first time I'd ever seen this week, and I was kind of flabbergasted when I saw it, because I was like, what? Like, why on earth would you move the student loan portfolio, which is $1.6 trillion, to the Small Business Administration of all places? Like, this is student loans for colleges, has nothing to do with the SBA. The SBA has never managed or dealt with anything like this. The SBA is not set up. I mean, the SBA, they can't even manage their own stuff right now. They can't even manage their own loans. They don't need to be given the student loan portfolio. That's not gonna help the SBA run any better. But a federal judge has blocked the Trump administration's plan to transfer the country's 1.6 trillion student loan portfolio to the Small Business Administration. For now, borrowers' federal student loans will be held by the Education Department. Now, I understand they want to get rid of the Department of Education, which, again, I have no beef with because I think the Department of Education is worthless. If you don't believe me, just look at the numbers. Department of Education was created in 1979. Have our numbers gone up since 1979? No. They've dropped like a rock in every category, by every statistic, by every metric. It's not to say the Department of Education has been a complete and utter failure is not even controversial. So again, I could care less if the Department of Education goes tomorrow. Fine, get rid of it. It's worthless anyway. But then the question becomes, what do you do with this $1.6 trillion debt? I think you need to give it to somebody, obviously, but I wouldn't be putting it with the SBA. Again, I don't know who came up with that idea, but it's not a good one. So anyway, but this judge basically blocked it, and now they're going to figure out, what it is that they're going to try to do with this portfolio. Again, I would say here, why not sell this to some banks? Why not go to JP Morgan and Bank of America? Why not sell this to these guys? Why not give them, why not give them something where you a big part of the reason why a lot of these bigger banks don't make as many, they do some student lending, but they mainly it's like, the private student loans. Why can't the government give these bigger banks some kind of incentive or backstop or something to basically say, hey guys, look, go do these student loans, go make all the student loans that we need, and we'll give you some kind of backstop, or we'll give you some kind of partial guarantee or something to entice them to want to do this. That would seem to me like the logical thing to do. But again, we'll see. Interesting stuff, no doubt. And then I think I've got one more article here on the student loan topic, and that is Republicans' plan for student loans would mean indentured servitude, college experts say. Now, here's another, just kind of ridiculous idea that I don't care for. Under House Republicans, the One Big Beautiful Bill Act, student loan repayment timelines could stretch on for up to 30 years. Longer repayment terms will only exacerbate the problem of more Americans carrying student loan into their old age, consumer advocates say. This has gotten absurd at this point. You seriously want people to take student loans out for as long as they would take out a mortgage to buy a house? You seriously want to? So you graduate college when you're 22. You're not going to finish paying off that student loan debt until you're 52 years old. 52. You're going to go to college for 4 years or 5.5, whatever. But then it's going to take you 30 years to pay that back. I mean, that's absurd. I mean, if that's the case, I would basically tell everybody, just stop going to college. Stop going to college right now. Okay. Nobody needs to take on debt that's going to take unless it's a mortgage. You don't need to take out debt for student loans. It's going to take you 30 years to pay back. I mean, it's utterly ridiculous. And again, I think I'm not in favor of it. I saw this and I was like, you've got to be kidding me. And it says, currently most student loan repayment plans range from 10 years to 25 years, which is true. I would say a lot of them are 20 years. A lot of them are on 20-year plans, which already generate concerns about people bringing their education debt into middle age and beyond. And we're just talking about undergrad debt. Okay, we haven't even gotten into like MBA debt. If you go to law school, you get a doctorate, you go to medical school, whatever. We haven't even gotten into all that ludicrous debt on top of it. So that's just kind of crazy. So a lot of things here with student loans that we need to keep an eye on and see how this continues to evolve in the coming weeks and months. But a lot of things I'm not crazy about. And I really think Republicans are handling this very, very badly. Yes. Do I think people need to pay their loans? Yes, you do. Sorry. You got to, you signed, you took out the debt, you got to repay it. That's how it is. Sorry. You got to figure it out. At the same time, I don't like what's being proposed here. I don't like, trying to give the SBA the $1.6 trillion portfolio. I don't like this idea of trying to give people 30 years to repay their student loans. I'm not crazy about some of these things. I don't like garnishing the Social Security benefits of seniors. That's not cool. I don't like that. So again, I just think I don't know what Republicans are doing with this, because it just seems it seems like a lot of really bad, stupid ideas, and I don't get it. So anyway, okay, let's run through. And some of these things I'm going to run through very quickly here, because I've only got about another 12 minutes or so here before I wrap up. So okay, so TD Bank Group is laying off almost 2,000 employees as part of their reorganization. TD Bank Group will cut 2,000 employees in restructuring. TD incurred $3.2 billion fine for anti-money laundering compliance issues. TD aims to reduce U.S. assets by 10% from $434 billion. So again, TD Bank still dealing with a lot of issues and a lot of fallout from that ginormous anti-money laundering issue they got there. U.S. foreign tax bill sends jitters across Wall Street. The One Big Beautiful Bill Act includes the most sweeping changes to the tax treatment of foreign capital in the U.S. in decades under a provision known as Section 899. So Section 899 will hit entities from so-called discriminatory foreign countries that impose levies that disproportionately affect U.S. companies. Under the new tax bill, the U.S. would hit investors from such countries by increasing taxes on U.S. income by 5 percentage points each year, potentially raking the tax up to 20%. I don't see what's wrong with this. Investment banks and law firms warn this step could prove to be as significant as the impact of duties on investors. Section 899 challenges the open nature of U.S. capital markets by explicitly using taxation on foreign holdings of U.S. assets as leverage to further U.S. economic goals. Okay. So you basically can't hold your assets in a foreign country to shield them from U.S. taxes. It's basically what's happening. That's how you have to read that. Sorry, guys, you're going to have to pay taxes on that stuff. You're going to have to bring those assets back here to the U.S. and you're going to have to pay taxes on it. Sorry. But of course, Wall Street's like, oh, we can't do that. That's terrible. All right, Opportunity Zones 2.0 tax bill could mean big changes for a popular program. So the Republican tax plan would extend Opportunity Zone programs through 2033. The new proposal would give greater incentives to develop in rural areas. Changes include redefining low-income communities and additional reporting requirements. So obviously the Opportunity Zone thing was a big hit. They're trying to expand it. They're trying to use it into more areas, which I think would be a great thing. We'll keep an eye on it and see how this thing unfolds. But hopefully, like I said, I think that this could lead to hopefully some good economic development opportunities down the road. Tax bill means big breaks and risks for middle market companies. So the Republican tax plan offers benefits for middle market companies. The plan also cuts clean energy tax credits and adds to the national debt. Experts warn of potential drawbacks despite R&D and depreciation incentives. And I'm trying to see where. So for middle market companies, this means if the bill passes, they would have a strong incentive to either maintain their current pass-through structure or for some C corporations to reevaluate whether converting to a pass-through entity would now offer greater tax efficiency. Friedman also stressed that for family-owned middle market companies, the permanent increase in the estate tax exemption to $15 million per individual is a boost over the current $14 million, adding that without the legislation, the exemption would be cut in half in 2026. But the benefits also come with drawbacks. Friedman said the clean energy sector could lose a series of tax credits and breaks, creating headwinds for that industry and forcing businesses to reevaluate investments in those areas. Not really crying about that. I think a lot of the clean energy stuff has been garbage. And a lot of that crap has been a scam, unfortunately. So, middle market M&A was expected to have a big 2025. Then a wild card entered the mix, a wild card, namely tariffs. Global M&A transactions are projected to decline amid trade war. Home services, artificial intelligence, and electrical generation are still hot sectors for deals. So deal makers had big expectations for middle market mergers and acquisitions in 2025. Although deal activity this year started off strong, the Trump administration's tariff roller coaster has more recently cooled the market. It just effectively dropped an atomic bomb on the deal market. It created a paralysis as people did not know how to react, said Christopher Fagan, middle market M&A expert and partner at accounting and advisory Moore Colson, about the tariffs. There is an expectation gap between where we thought we would be and where we are in terms of deal volume. So, all right. So we'll keep an eye on it. We'll see what happens with global M&A and see if we get a pickup or whether it stays the same. Remote work has shifted how companies delivered layoff news. I thought this was really interesting. So if you work remotely, only 30% of laid off workers were basically getting informed face to face. Basically, most of them were getting informed like via email or text messages, which is terrible. But most recently, laid off workers were not given the news in person, a trend that's becoming more prevalent with remote work. A ZETI survey of more than 1,000 workers who had been laid off within the past 2 years as part of the company's 2025 layoff experience report found just 30% were told of their termination in face-to-face meeting. Another 29% were notified by mail and 28% were informed via phone call. Meanwhile, 6% of laid-off workers said they heard about their own termination through company rumors, and 5% were given the news on a video call. Just 2% found out after losing access to internal systems. The most frequently cited reasons in the survey for the layoff were cost-cutting, company downsizing, restructuring, and poor financial performance. Most workers did not blame themselves, as 53% said their layoff was because of company challenges. About 42% said their performance contributed to their layoff, but was not the main reason, while 5% said their performance was the primary cause. And then it goes into another number of things found, but I just thought that was kind of very interesting for remote workers, that only 30% of them were basically being told, in person, so to speak, that they were being let go. It's kind of crazy. So, this is really fascinating. Ron DeSantis, he signs this gold money legislation into law. This new law, passed unanimously by lawmakers in both chambers, aims to create a system that citizens can use to transact with gold and silver. So basically what's happening with this in a nutshell is that this is the way that this is going to work, is that you would be able to take gold and silver and go to your bank, and you would be able to open up an account and then put that gold and silver on deposit at the bank. And then you could literally get a debit card for that account and then go out and spend that money. And then I guess as you spend the money, as it gets to a certain area, a certain amount, they'll then, the bank will then take the gold and silver, sell it, convert that back into dollars, and then you'll have to keep depositing more gold and silver in there in order to use it in that fashion. But I just thought that this was fascinating. I thought it was really interesting, and we'll have to keep an eye on this and see how this evolves. But I think what was really amazing, what it was passed unanimously by both Republicans and Democrats in both sides of the chamber there down in Florida. They both basically passed this with, no issues, unanimous vote. And it's just fascinating. I think is really interesting. It creates a framework for precious metals to become a part of everyday commerce with backing and authorization from the state. Eventually, the law will pave the way for consumers to use a debit card style card or app to pay for everyday needs with precious metals held in depository. Merchants, though, could choose to be paid in dollars if they prefer. The metals are now considered legal tender under state law too, making them exempt from state sales taxes. So this is this is just really, really fascinating stuff here. So, OpenAI shakeup plans get SoftBank's nod. All eyes now on Microsoft. So, so basically, a lot of things are happening with OpenAI. I'll probably talk a lot more about this in the next coming weeks. But obviously, OpenAI was trying to change from a nonprofit to a for-profit. That was ridiculous on its face and was never going to happen. And finally, they found out that wasn't going to happen. And obviously, SoftBank had invested a lot of money in OpenAI, which they basically said was contingent upon them being able to convert to a for-profit entity. Now, obviously, SoftBank is saying, well, hey, okay, you can't convert. That's okay. We're still going to give you the money, the investment. Now, basically, the eyes are back on Microsoft. Like, what's Microsoft going to do? Are they going to continue to go along with OpenAI, or are they going to, bail out? So we'll definitely talk about that more in the weeks ahead. The U.S. now has a third of the world's millionaires and billionaires. So very, very interesting. So the U.S. remains a hotspot for the world's wealthy. America now has more than 6 million liquid millionaires, or those with investable assets of more than $1 million. That's up 78% over the past decade, according to a report from Henley and Partners and New World Health. So we got a lot of millionaires and billionaires here in the United States, ladies and gentlemen. That's a wonderful, beautiful thing. Okay. All right, guys, I'm going to start the wrap-up process here. I got two things for you that I do every episode. I've got the story of the week, and then I have our quote of the week. So let's do, which shall we do first? Let's do our story of the week. So we're going to talk about the Bank of England this week. So the Bank of England, also known as BOE, is the central bank of the United Kingdom. The BOE oversees monetary policy and issues currency. It also regulates banks, financial firms, and payment systems. Like other central banks, the BOE may act as a lender of last resort in a financial crisis. The primary goal of its monetary policy is stable inflation as defined by the government. The BOE sets policy 8 times a year, primarily through the bank rate, the interest rate it pays banks on reserve balances. So Britain has the British pound and the sterling. BOE publishes a biannual financial stability report. And very interestingly, the Bank of England was created in 1695 and was the very first central bank, bringing in kind of the modern world of finance that we now know over the last few hundred years. But it was Alexander Hamilton that looked at the Bank of England, obviously the central bank for England, and basically tried to use that as a lot of his model for what he wanted in the U.S. Now, obviously, there was a lot of pushback on Alexander Hamilton at the time because a lot of people said, no, we just broke away from England. We do not necessarily want England's economic model. We want our own economic model. We want a capitalist economic model. We want a system that's unique to America. But even despite that, Alexander Hamilton said, I want a central bank. And he got the first he got basically the Bank of the United States, which ultimately became the first central bank in America, which was basically chartered in 1791. And the original charter ran for 20 years until 1811, when John Madison canceled the charter because basically he said we did not want a central bank. And as I remind people all the time, the Federal Reserve is not America's first central bank. It's our third. It's our third central bank. And the first two got crushed, once by James Madison and the second time by Andrew Jackson. And they had very valid reasons for getting rid of the central bank. So for anybody out there that basically says that the Federal Reserve is permanent and is something that cannot be gotten rid of, I would remind you of history. That yes, in fact, we have had 2 central banks before the Federal Reserve. They were both gotten rid of, and they were gotten rid of for very, very good reasons. So I'm not advocating that at the moment, but again, this is just history. I like to tell everybody history of banking. It's important to understand this stuff because history tells us where we're going in a very real regard. So, okay, what is our quote of the week now? So, you guys ready? The difference between a successful person and others is not a lack of strength. It's not a lack of knowledge, but rather a lack of will. And that was from famous football coach Vince Lombardi. Great quote from him. So I will wrap up by basically I thank everybody so much for hanging out with me again on a Saturday night. I hope we had a lot of good, interesting stories. I hope people found a lot of this stuff interesting. If you do, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. As always, make sure to check out some of the other content content on the channel. I post videos every day, Monday through Friday at 12 noon is when they usually go up. Most of the videos are only about 10 to 20 minutes in length. So, small bites, easy to consume. And like I said, I hope I'm putting out very interesting topics that people, find, a lot of use and value in. But like I said, I thank everybody so much for listening. I thank everybody for being patient and hanging in there with me while I was going through all my, medical issues last week. But hopefully, God willing, everything's cool now. I'll be good, and I'll be seeing you guys a lot through the rest of the summer here, and as we get back into the fall. But I hope everyone has a great, wonderful, awesome weekend out there, and I will see everybody again real soon. I will put up some posts this week on YouTube. Just keep an eye out if there is in fact going to be a live stream or some kind of live stream next Saturday. I'll let everybody know sometime this week, and then, like I said, we'll take it from there. If not, I will definitely be back normal live stream Saturday night the week after. So, but with that being said, have a great weekend, everybody, and I'll see you again real soon. Thanks a lot.